Hi, thank you for joining. My name is Kee Gann, Chief Investment Officer of L1 Capital UK Property Fund. Bit of introduction around L1. We're an Australian-based fund manager founded in 2007 by Raphael Lam and Mark Landau, and today we have about $3 billion in assets under management. Today we're talking about the UK Property Fund, which was established in 2017, and that was to take advantage of an opportunity where we found the asset class delivered very high rental yields of between 7 or 8%. Interest rates were very low, where we could actually borrow at 2% cost of borrowing and achieve strong positive gearing. And interestingly, house prices were very affordable from a price to income perspective, trading around 4 times or 5 times price to income, which was substantially lower than other developed countries. So on the basis of that, we found that it was a relatively attractively priced opportunity versus a lot of other asset classes which were quite expensive. And over that time period, we've now have raised 3 prior funds and currently have a total of $250 million in assets under management for the strategy. I think over the page, the fund invests in basically fully tenanted blocks of flats in Tier 1 cities outside of London. So cities such as Manchester, Birmingham, Sheffield, Leeds, where actually about 80 or 85% of the population actually live. What's key to any investment that we invest in is valuation. For housing, it's defined as affordability or price to income. In a lot of these cities, prices are typically about £150,000 per house, or around 4 times price to income, much lower than what we're finding in Australia, where Melbourne and Sydney trade at around 9 or 11 times respectively. When we look at how house prices have tracked over time in the cities outside of London, over the past 15 years since the GFC, house prices outside of London are only around 10 or 20% above the levels they achieved back in 2007. People's incomes, on the other hand, have grown by around 45% over that 15-year period. What that has meant is now prices are very affordable because incomes have outperformed house prices. Rental yields are very high, typically around 7 or 7.5%, which is much higher than what we see in Australia and also much higher than in London, which gives rise to what we call positive gearing or a strong positive dividend yield. So in many ways, we find this quite attractive, given when we compare it to Australia, you're looking at largely the opposite scenario. Worthwhile touching very briefly around how the sector has performed throughout the pandemic. Interestingly, when you look at UK rental prices over the past 70 years, there has been not a single year where prices haven't declined. So prices are relatively very sticky and grow in line with inflation at around 2 or 3% per annum. The residential sector has also held up very well from a collection rate perspective. So 96% of all rents which are due throughout May, which was the most probably uncertain month throughout this pandemic period, 96% of rents were still collected. Other sectors of the property market, particularly commercial, saw a large drop-off in tenants' ability to pay rents. When we look at house prices, it's really a number of events that's happened over the past 6 months. In January, February, house prices were really starting to recover quite strongly on the back of the UK election and Brexit finally occurring in January earlier this year. Throughout February through to May, which was really the height of the pandemic, the most uncertain period, house prices were just really relatively flat. No one was buying, no one was selling, and that was probably the most uncertain period we had over the past 6 months. Come forward to May and June, where lockdown restrictions eased in the UK, we saw house prices started to rebound, return back to growth, and the recent announcement by the UK government to actually remove stamp duty for prices below £500,000 is likely to act as a strong positive tailwind for the sector going forward. Talking a little bit around what we do. So we buy fully tenanted blocks of flats in Tier 1 cities outside of the UK, which are already tenanted, and therefore we can start delivering an income or a dividend back to investors from day one. We typically like to find buildings which are in great locations, such as this example here, a recent investment we made in Liverpool city centre. Whilst we don't do any construction or development, we found that if we do 2 or 3 things different, in this case, it wasn't about refurbishing it, but it was about adding some more premium furniture, making it look a lot nicer visually, and that allowed us to deliver about a 20% increase in the rents. Over the page, this was a recent investment we made late last year for a residential building in Sheffield city centre. Again, Tier 1 city, great location. It's right in the middle of Sheffield, right between the 2 universities. And it was a building that was vacant and in need of a bit of a refurbishment. So what we've done is done a light touch refurbishment, look to try to fill the building now at rates which are still one of the cheapest in Sheffield at about £100 per week. And once the building is fully tenanted, that would translate to around a 20% rental yield. So again, it's about buying great locations, slightly under-managed assets and repositioning them. What's probably helpful on the next slide is to give a feel of how the return profile of an asset performs throughout its life. So this was one of the early investments we made back 3 years ago in 2017 that we've owned for about 3 or 4 years. So what you can see is over that period, we have generated about £250,000 to £300,000 per annum in net rental income. And that's what has supported about a 7% dividend yield that's being paid to investors out of the fund. The rental income has actually grown by around 29% over that 3-year period. And that was really down to 3 factors. One, there was a commercial unit on the ground floor that we refurbished and let out on a new 6-year lease. 2, there were a number of flats which were very much under-rented or being rented at below market rates, and our focus was getting those tenancies back to the market level. And then 3, a lot of our body corporate costs or service charges were being optimised, which helped improve the net rental income. That's helped deliver a solid capital gain, and then in total, once you subtract off all expenses and stamp duty costs, over that 3-year time period, it's about 1.5 times money multiple or around a mid-teen IRR. I think finally, another theme I think worth touching on very briefly is we do invest in blocks of flats, and one of the benefits that we get from that is when you buy a whole block of flats, it's typically a 20 to 25% discount to the retail value versus if you're selling it one by one. In this situation, because we bought a very large block, which was probably too large for the fund to own over the long term, we sold down about a third of the portfolio and crystallised it at retail value, which generated a premium of around 25% to our entry price. So I think in just summarising the fund and our investment objective, the target is to deliver a 6 to 7% dividend yield, and that's derived from rental income, which we feel is fairly defensive and non-cyclical. The prior funds, Fund 1 and Fund 2, are delivering dividend yields in excess of 7%. And the investment objective is to deliver a total return or a net total return of a minimum 10% per annum. The prior funds, Fund 1 and Fund 2, have also exceeded those objectives. What we also like from the fund is that the returns and the asset class is very much uncorrelated to typical bonds and equities. And we find that the return profile has been quite asymmetrical. You don't have to believe too much to deliver the rental yield and the dividend yield, which is quite defensive. And if we can continue to get 2 or 3 things right in repositioning each asset, that's what allows us to drive the capital growth over the life of the fund. Thank you for your time for joining the presentation, and please feel free to reach out with any questions.